Good afternoon, ladies and gentlemen. Thank you so much for joining us today for the IPO meet of Petro Carbon and Chemicals Limited. Let me give first a very small brief about the company. Petro Carbon and Chemicals Limited is part of Atha Group. We are engaged in the business of manufacturing and marketing of calcined petroleum coke (CPC) in the carbon industry. Also, let me give some highlight about the group. Atha Group is a 70 years old group and is a multi-product, multi-technology, multi-location business conglomerate headquartered in Kolkata. The group was founded in the year 1957 in Odisha as a mining and minerals company. Also, I want to highlight about the IPO details. The IPO opens on 25th June 2024 and closes on 27th June 2024. The issue size is up to 113.16 crores with a price band kept at 162 to 171 rupees. Today, I would like to welcome the management of Petro Carbon and Chemicals Limited. We have Mr. Vishal Atha, Chairman and Managing Director of the company, Mr. Arun Kedia, CFO of the company, Mr. Vishal Vithlani, Group Strategy President of the company. Also, I would like to welcome Mr. Ankit Keshwarnani from GYR Capital, who is our book running lead manager. Now, I would like Mr. Arun Kedia ji to please give a small opening remark.
Good afternoon, ladies and gentlemen. I am Arun Kedia. I am the CFO of the company. It is my great pleasure and privilege to be present here before this esteemed gathering of investors. And I extend a very warm welcome to you all in this first ever investor meet of our company. PCCL was acquired in 2007 by Atha Group, and it has traveled a long distance since then in last 17 years. But today the company makes a new beginning. Today is the day of first official and formal dialogue which we are having with the investor community, and I hope it is the beginning of many such events in future. Coming few weeks are going to be momentous in the history of our company. PCCL, which was established as a small private endeavor by Atha Group, has now acquired wings and is ready to fly. I, on behalf of the board of PCCL rather, promise that we shall do everything in our control to deliver and come up to the expectations of our investors and stakeholders. In next half an hour or so, we shall be making, during the next half an hour, we shall be making a small presentation. And in that, I will try to speak on, what PCCL does, how it does, and how we are trying to create value for all our stakeholders. Palak would be helping me in making that presentation. And Palak, should we start with the presentation now?
Sure. Yeah. Thank you, Arunji. Let's move forward with the presentation.
So here comes the slide. This one is the boundary and contents, the customary disclaimer slide. The growth tracker slide is one of my favorite slide, and it covers the 49 years journey of PCC in one page. What was started in 1975 as a small petrocarbon unit, and it was acquired by Atha Group in 2007. Post that, we made a lot of revamping and changes in the plant, supplemented the team, and in last 2-3 years we have made a second round of upgradation and revamping, under which we made substantial improvements in our kiln, added new technology, made new improvements, added new balancing equipments, etc. The end result of which is extremely higher capacity utilization of the kiln, which is now nearing to 90%, better economies of scale, lowering of operating cost, and creating better value for the company and its stakeholders. Next slide, madam. This slide is a result of the endeavors which we have put in last 2-3 years. The left side depicts the revenue growth of the company. As we can see, in 2021, the turnover of the company was 152 crores, and it has grown up to more than 500 crores in FY23. And even during the first 9 months of the current year, the turnover has crossed 445 crores. This substantial increase in revenue was a result of better economies of scale, higher capacity utilization, better timing of sales orders, wherein the sales order procurement was optimized and it was obtained at the height of the pricing cycle, and then subsequently the supplies as well as procurement of materials have been timed and efficiently done to take advantage of the falling prices of the raw materials. And also, because of the technological improvements, the reduction in operating cost has helped us to achieve better margins. The optimization of freight cost was again a factor, and all these optimization factors have contributed in net profit margins of the company increasing substantially. As we can see, in the first 9 months of the current period, the net profit margins have gone up to 15% from the low levels of 10-11 kind of percentages in last 2-3 years. Next. This slide depicts the EBITDA margin increase and the increase in the return on capital. As I had explained in the first slide, we had made a second round of major upgradation and improvements in our manufacturing facilities, and we had spent a high amount of 22 crores in FY 21-22 and 22-23 to improve the kiln and improve the efficiency and technological parameters of the kiln. Because of these improvements, the company could achieve higher EBITDA margins, and which is reflected in the good performance of the company in last 9 months. The EBITDA margins are now more than 20%, and correspondingly, the return on capital employed has also shown 5-6 fold increase. From the level of 10%, it has gone to 60%. Next. Mr. Vishal Atha from the Atha family leads this company. He is the chairman and managing director of the company, and he has been at the helm of affairs of this company for last 20 years. Besides this business which he leads, he also contributes and helps in the other businesses of the Atha group as well. In subsequent slides, we will talk in detail about the profile and experience and the contributions made by all the board members. Next. And this is the slide about the business model of Petrocarbon. We are a B2B company wherein we procure bulk raw material from crude refiners, and then we process it and sales to reputed aluminium and steel companies. As mentioned in this slide, two of the large aluminium companies, Hindalco from Aditya Birla Group and Nalco, a reputed PSU Navaratna company, are among our largest customers. Besides these two customers, also we cater to other aluminium companies and steel making companies, and we have had deep relationship with our customers, which is reflected in many awards and recognitions given by our customers. The notable among them is a Nalco Vikreta Utkarsh Puraskar won by us in 2018, and it was awarded by Nalco for our consistent and large supplies made to Nalco, which helped Nalco in its business operations. Next one, Palak. So calcined pet coke is one of the purest form of carbon, and it is used primarily in aluminum and steel industries. Besides this, it also finds application in other industries like batteries, titanium dioxide, chemicals, etc. Next. This slide explains the complete life cycle of RPC and CPC. The CPC is made from raw petroleum coke, which is heated and processed through a process of high temperature roasting. In that process, the various chemical and physical properties of RPC are transformed to make it more pure and more conducive to electrical conduction, and then this becomes suitable for its application in aluminum and steel industries, and it has been in use in these industries for more than 100 years. And because of the growth in these basic industries, the CPC also has a good future. This slide gives a pictorial description of the manufacturing process of CPC. As I had explained, the CPC is made from raw petroleum coke. It is then put in a kiln, and in which it is heated to a high temperature of 12, 13, 1400 degree. And in that process of roasting, the chemical properties and physical properties are changed, and it is made into a purer form of carbon, which is conducive to conduct heat and electricity. The business model of the CPC industry is closely linked with aluminium, as 70 to 75% of the use of CPC is in aluminum industry, and globally this commodity is traded in delivered long-term price basis. And because of the bulk nature of the commodity and the high incidence of freight cost, it is not geographically interchangeable. So mostly it is used in particular areas where it is produced and consumed, so as to reduce the incidence of transportation cost and freight cost. Volumes play a major role in this. Therefore, our focus on capacity utilization and reduction in freight cost is one of the biggest strength of the company and a major value driver and growth driver of this company. Next. On the raw material side also, the industry requires handling of huge volumes, because to produce 1 ton of CPC, we need about 1.36 tons of RPC. Hence, the volume handling of raw petroleum coke is bigger than the CPC, and more efficiency is required in terms of geographical location as well as freight optimization, so that the cost of the production of CPC is manageable and efficient. Because of our location at Haldia and nearness to port, we are able to procure raw petroleum coke at a very competitive price, and freight cost is very manageable, and that helps us to produce CPC at a very competitive price, and is one of the big contributing factors in the success of our company. Next. This slide explains our customer relationship model, and PCCL has a very deep and well-entrenched relationship with our customers, wherein we deal with our customers directly without the intervention of any of the intermediaries during any of the process of order procurement or shipment or transportation of the material, or even post-sale closure issues. Everything is done directly, and we understand the customer needs, and then thereafter calibrate our manufacturing process so that we deliver the correct material and as per the correct periodicity to our customers, which are large aluminum companies and large steel makers. There is a periodical process of meetings and collaboration, etc., to iron out any issues or even solidify the relationship. This slide shows the capacity utilization. As we have explained, due to the bulk nature of the commodity, the economies of scale and capacity utilization plays a very significant role in success of CPC industry. We have, due to the various improvements made in our manufacturing process, has now established our manufacturing process, and we have been able to increase our capacity utilization percentages from 60 to 70, which was prevalent 2-3 years back, to the levels of 90-92% in last 2 years, which has resulted in better turnover and better profit margins for our company. Now we are almost able to produce about 100 lakh tons of CPC every year, which is the annual capacity. Next slide, madam. Coming on to the growth drivers and the competitive edge of our company, the strategic location, which is at Haldia, is one of the biggest factors contributing to success of PCCL. We are absolutely at the port of Haldia, within the Haldia port zone. We are connected to the railway line of the Haldia port. The road connectivity is 2-3 kilometers away. The railway connectivity, which is the passenger rail station, is only 2 kilometers away. We have our own in-house captive railway siding within our factory, and the electricity connection is also only 2.5 kilometers away. The end result of all these factors is that we are able to seamlessly procure raw material from Haldia port to our factory at least cost and within no time. The per ton cost of procurement of material from port to our factory is few hundred rupees only, compared to large amounts which other companies would be incurring. Next slide, madam. This slide shows our competitive advantages and the factors which contribute in making our business model strong and robust and highly profitable. So logistics and control over transportation is one of the biggest strength of our company because of our strategic location, nearness to Haldia port, connection to the road network, as well as railway siding within our plant. We have absolute control over transportation and logistics, and we are able to procure raw material and send material to our clients at least transportation cost. The technological, just previous slide, yeah. The cost effectiveness extends to the other areas also because of our kiln improvements and high substantial investments made in last 2-3 years and higher capacity utilization. The overall cost of production of our CPC is very, very competitive. The utilization levels of the plants are now nearing 90%. So the incidence of fixed cost and depreciation and other fixed costs is very low. We have a bunch of dedicated, talented individuals, which is led by Mr. Rudhshen Singh and guided by our board, led by Mr. Vishal Atha. This team is working tirelessly in achieving the results for our stakeholders. Next. As we had discussed that the fortunes of CPC industry is linked to aluminum and steel, and both these industries are growing almost at a rate of 7 to 9%, particularly in a country like ours, which is investing heavily into infrastructure and industrialization is helping, and capex cycle is now picking up. So the future of both these industries like chemical and steel is very, very bright, which would mean in turn the increasing demand for CPC industry, as usage of CPC is very well established in these two industries. It has been in use for more than 100 years. So the future of the industry is very bright, and we hope demand to grow at the rate of 7 to 9% for CPC industry. Next, madam. At PCCL, we are very, very committed on ESG compliances. We are doing all our bit to reduce emissions and contribute to the well-being of Mother Earth. The attempt to comply with law is not only in letters but also in spirit, and it is well-established principles for the whole Atha Group in all its business affairs, also in Petro Carbon. The petrocarbon is part of the larger chemicals industry group, and as depicted in this chart and diagram, the industry has been growing at a CAGR of 5 to 6% in last 5-6 years, and it is expected to have a similar growth rate in coming years also. Hence, CPC industry also would ride this growth wave, and I had mentioned in previous slides that particularly CPC industry would have a better growth rate because it is directly linked with two basic industries, both of which are expected to grow very, very rapidly, particularly in our country. Next. So this slide explains the SWOT analysis, and we have discussed all these factors in our previous slides, so I would not elaborate much on this slide. Coming to our team, Mr. Vishal Atha leads this team. He is the managing director and chairman of the company. He is the fourth generation businessman from Atha family, which is a very old business family of India, and they have been in this business for more than 70-80 years. And the group was started with a business of mining in Orissa, and then gradually group expanded its base in petrochemicals, petrocarbon, steel making. Mr. Atha leads this company entirely, and then he also contributes to the other businesses. Supporting Mr. Atha is a team of great individuals led by Mr. Rudra Sen Singh. He's the executive director and head of our factory. He's a very veteran in petcoke industry. He started as a chemist in this company about 50 years back, and now he's heading the operations and the plant of the company. He's a chemical engineer and is a very well respected individual in petcoke industry. I handle the finance functions, and then we have a full team of professionals who are heading their respective areas. The company works on a principle of complete compliance and then following set SOPs and procedures for its business policies. We have reputed consultants, helping us in our compliance and other functions. And we also have a very well diversified board of directors, wherein we have individuals like Mrs. Mamata Binani, who is a senior practicing company secretary from Calcutta. He was also the past president of the Institute of Company Secretaries of India. Then we have Mr. Amit Ganatra, a chartered accountant and a partner in a reputed law firm, Khetan and Company. We have Mrs. Ramya Hariharan. She's a senior lawyer and managing partner of Citadel Law Chambers. We have Mr. Viral Shah, a financial expert, and he runs a financial advisory and wealth management business in Ahmedabad. So all these individuals are very talented in their respective area, and we get really good insight and help from our board in running our company, Petrocarbon. Next. So coming to the financial results, these are detailed financial figures of last 4 years of our company. As we can see, we had a stupendous growth in turnover from 155 crores in FY21. The turnover has increased to more than 500 crores in FY23. And during 9 months itself, we have crossed 447 crores. Correspondingly, the profits have also increased. Next. In line with the performance, the net worth and capital of the company has increased. Presently, we stand on a net worth of close to 150 crores at the end of the 9 months period. And the financial structure and financial position of the company is very robust. We are supported by adequate bank lines. We have around 300 crores of working capital lines from 7 commercial banks in order to help us in our procurement and working capital functions. I think that's all from me, madam.
Thank you so much, Arunji. It was a really great and detailed presentation. Now, also I would like to show a very small glimpse of the factory of Petrocarbon and Chemicals Limited. Thank you so much. It was a small glimpse of the factory. Now, I would like investors to have a small Q&A session with the management so that we can have a small interaction. We would like to take a small moment to arrange for the questions. So, moving forward, let's go with the first question. So, first question is, can you throw some light on the freight cost and what percentage it is of total revenues?
So I will take this question, Palak.
Yeah.
As we discussed in the presentation, the freight cost is not a separate line item in our financials or in our cost structure. On the raw material side as well as on the finished side, the pet coke industry is traded on a delivered firm price contract basis. So freight cost is always included in the procurement rate or in the sales rate. But because of the location of our plant, because it is just at the Haldia port, the incidence of the freight cost in our case is very low. And 900 to 1000 rupees is the total cost which we incur for lifting the material from port and bringing up to our factory. On the sales side, since we have a railway siding, we just load in the railway wagons within our factory, and then through the railway network it travels to our buyers, which are either the aluminum companies or steel companies, and they are also within a small distance. Our most of our buyers are either in Orissa or in near UP or near MP, so it does not travel from east to west or north to south. So on the raw material side, we incur about 1000 rupees per ton for bringing material to our cost. And on the sales side, we incur anywhere between 1200 to 1500 rupees for reaching our material from our factory to the plant of our buyers. On a percentage wise basis, it would vary between 3 to 5% depending on where the commodity prices are. And if you compare with others, who are having a plant not on a favorable location, it may go up to even 8 to 10% in case of other companies. So, we are very efficient on this freight cost front.
Thank you. We have another question, which is, how do you see the shift in demand-supply gap in the industry?
Good evening, Arun sir. If you don't mind, I'll take.
Yeah, Vishal, you please take this.
Yeah. Good evening, investors. I'm Vishal Vetlani. I'm heading the strategy division of the company for the group as well. Palakji, the question that investors ask. Thank you so much for the investor to really throw light, on the demand and supply gap here in the industry, right? So, as Arun sir just mentioned, that steel and say aluminum would be going to grow anywhere from 7 to 9%, let's say, in a foreseeable future. I would say that, we are benefited as a country from, let's say, Make in India concept. So world over, people are talking about China plus one strategy. Now, Indian, say, aluminum steel players are really benefiting from that, where the exports are growing from Indian manufacturers. So Vedanta, Hindalco, Nalco, SAIL, all are expanding the capacities, right? And the idea is, if you are supplying or catering to this industry, which is B2B from, let's say, CPC industry to steel and aluminum, this is where the growth would come in, right? So in our case as well, if you see last 2-3 years, the tide has changed for the CPC player, the CPC industry, right? And what has happened, that the demand and supply is kind of now in balance, in equilibrium. And as the aluminum and steel players are going to put more capacities, 7 to 9% growth in, let's say, next 6-7 years, you would need enough of CPC tonnage and volume to be manufactured in India, and hence the entire industry would grow. So we would say that the CPC industry should have a good time from here on, maybe for 5, 7, 10 years.
Thank you. Thank you, Vishalji. Next question is, who all you believe are your competitors and what are the threats to your company?
I would take this question again. Palakji, I would tell investors that, it's a very small industry, right? So it's oligopoly in India, right? We have around 5-6 players who kind of really lead the majority of the volume here. So let's say Rain Industries, Goa Carbon, Sunvira, India Carbon, Petro Carbon Chemical. So Neo Carbon, about 5, 6, 7 people who kind of really have a major share of the entire CPC market, right? And we wouldn't say competitors, right? Because it's oligopoly. You understand that you have a large investor to really cater as well, and there is a demand which is really outpacing the real say supply available. So I wouldn't say that it's a threat. I would say it's like industry which is growing. Everybody is growing. Let's say at a different space depending on what competitive advantage one has. But I guess it's a good tailwind that company has, a good tailwind that the entire industry has, and I would say that it's really good. There is no threat per se, and I guess people are putting an industry and itself. CPC is putting as much efforts as can be, to really meet the demands that is coming through.
Thank you. There's another question, which is, how do you manage raw material price volatility?
So Vishal, I'll start. You add supplement. So since CPC and RPC, is part of the petrochemical industry, there is some bit of volatility in prices, and this is a risk which needs to be managed. But unfortunately, it is not a commodity which is traded, anywhere on the exchange, and we can buy a hedge. So it is not that straightforward risk management possibility. What we try and do in order to manage the volatility or the risk of raw material prices is to diversify the procurement sources, have multiple products with different compositions from various locations and geographies, so that we are in a position to mix and match, and then achieve on a desired mix of quality as well as cost. So diversifying and having different types of products is one strategy. And secondly, we also try and do the timing matching. So whenever we are procuring a sales order, the procurement planning starts at that time itself, so that we are in the same cycle. So where we procure sales order, in the same cycle we try and lock into the raw material procurement, so that we are not out of the cycle and we don't expose our business to the risk of time and the volatility of the raw material. So basically, these 2-3 strategies we adopt. And Vishal, if you want to add anything, you can.
Yeah, just one factor, I guess, I would just touch base upon the volume because it's B2B industry, right? So Arunji, the way you mentioned is about the volume. So what happens that, once you talk to a client, you need to customize the, say your product in your CPC as per the client requirement, right? Now, once you know what client needs at what price, right? And you kind of really have that final negotiation or maybe signing the PO or something, we really have the entire team ready and available to really talk to enough of RPC suppliers, try to work out the best possible metrics that we can really work with, and then really, lean on to the completing the entire RPC contract as well. Now, since the efficiency has improved in terms of throughput, I require around 125,000 tons of RPC, which is a large quantity, right? And this quantity really helps us to negotiate the best rate from the supplier of RPC. Also, they would, let's say, make it delivered to the plant, so we can actually negotiate on the logistic cost as well. So I guess this is where, we can't go out of the fact that we are in a commodity processing industry, right? We do manufacture what is given to us in terms of commodity pricing and all. But I guess it's all about how to mitigate the risk. The way Arun sir has just mentioned, I guess we really go about that, and we are the people or the company who say we would like to take the least risk possible and try to really value add from our own competitive strength rather than actually going for the price differential, very frankly. Yeah.
Thank you. Next question is, how do you see margin sustainability?
I guess I will start and maybe Arunji can help me. So Palak, and thank you investors for really asking the question, right? So everybody would be really looking at what kind of margin the industry has, and CPC industry would be no different from any other say community-led operating entities, where the margin would be anywhere from low to mid-teens, right? And this is how the normal margins would be or should have been. Now, you understand every industry is a different level, and since CP is on a tailwind, you would say margins may be slightly going up or something, but I guess it is a limited level right now. But if the player, the CPC industry per se, because demand is outstripping the supply, I would say that CPC industry should have some kind of a pricing power maybe going forward, and the normal margins maybe come later on as well. But hopefully the things should look better from next 3 to 5 years point of view, Palakji.
Vishal, we can, see the margin comes from revenues and costs, and we here focus a lot on cost, try to have the minimum or the low raw material cost, low operating cost, low freight cost. So we try to manage costs, and at the same time, focus on the deep customer relationship, understanding the customer and supply quality product, so that on both fronts, we try to have little bit of control, so that in any situation, we would be in a better position to capture whatever is the available margin. It does not go out. So on the both fronts of the margin drivers, revenue as well as cost, we focus individually also on the important components of that.
Yeah. So I would just complete this. Palak, the way Arun sir just mentioned, right? As a commodity manufacturing process player, we can't have the pricing. It's kind of a popularly competitive kind of pricing where you are taking the price what industry is giving you. But I guess our real control, I mean not control, but I say our real focus on the cost. We would like to really work on every cost that we're incurring, focus on that. Logistic cost is of course very very focused for us, and we really work on that. We do a lot of focus on blending and sourcing the material at the right price from the right player. And this is where the real difference would be coming in. And with the current size of the company right now, I guess it should be good for us, hopefully in the future as well, to really push on the cost driver to remain competitive. Palakji.
Absolutely, Vishal.
Yeah.
Thank you, Vishalji and Arunji. Moving forward, next question, which we are taking is, what are the new developments the company is looking at?
So, Palak, thank you. Thank you for assisting us with the presentation, and thank you, Vishal and Arunji, for the excellent discussion so far. I would like to take this question for everyone. I would like to first of all thank everyone from the investor fraternity for joining us in this presentation and showing great interest in our company. When it comes to new developments, our organization has always made them a priority, starting with investing into facilities, technology, operations, supply chain, people, and these all investments are towards achieving a better utilization and efficiency for the company. Needless to mention, and this has all been done to achieve a better utilization and with higher standards of care. Having said that, we are continuously seeking opportunities to enhance our operations, and whenever such opportunities arise, we as promoters have always been the primary source of funding to grow the business and generate wealth for all our stakeholders. So, in all, these new developments has been the core of our company, and we have been consistently evolving and also been looking for opportunities where we can develop and ensure this company grows and create some great value for our stakeholders. So I think this is what our company's goal has been for so far.
Thank you so much, Vishalji. I would just like to mention that this was the last question which we would have been taking, and if any investors have any further questions, you can always email us. We have mentioned our email IDs in the presentation. And now I would just like to highlight again our IPO details. So our IPO opens on 25th June 2024 and closes on 27th June. The issue size is around or up to 113.16 crores, keeping the price band between 162 to 171 rupees. Thank you so much. That was all. We would like to conclude our session today.
Thank you, madam.
Thank you.
Thank you, everyone.
Thank you, everyone.
Thank you.
Thank you.